Forward Guidance is brought to you by Van Eck, a global leader in asset management since 1955. You'll be hearing more about a Van Eck ETF later on, but for now, let's get into today's interview. We are recording the afternoon of Wednesday, June 12th. Fed Chair Jay Powell just got off the podium addressing reporters at the Federal Open Market Committee. Today was a very strange day in that we had both a price index inflation report in the morning and then the Fed meeting at the very same day. So lots of news. The morning inflation report came in lower than expected, 3.3% on the CPI versus the 3.4% expected, which drastically lowered yields that sent the stock market soaring for the rest of the day. And the Federal Reserve dot plot, the statement that came out this afternoon, 2 p.m., priced in fewer cuts than the market expected, so nominally more hawkish. And the press conference as well was very, very interesting. And I wonder if it's safe to say that it was the more hawkish from the Fed than the market expects. I'm very curious to see what my guest has to say. I am joined by Jim Bianco of Bianco Research. Jim, so glad to have you here back on Forward Guidance. Welcome back. Did you think that the Fed meeting today was hawkish?
Hawkish in the respect that the Fed went from, let's start with 2024. They went from, on their dot plot, 3 cuts for the year down to 1. And the argument has been made that the Fed does not want to start and stop. So in other words, they weren't going to make that first rate cut in September. And then they got 4 rate cuts in 25 and then wait 2 meetings, skip the November, skip the December meeting, and then maybe cut a second time in January. So the inclination was if there's only going to be 1 rate cut, it's probably going to be in December. But maybe Jay Powell will talk you back into thinking that, no, they might go earlier and then pause before we get that second rate cut. And he didn't do that. So if you take the dot plot at its face value, and I might add, it's not always right, it looks like we're still 6 months away from that first rate cut. And that's provided, of course, that the data cooperates. And the cooperate means, in this case, it weakens. The labor market data weakens, the economic data weakens, the inflation data continues to weaken in order to justify that rate cut. Remember back in January when we were thinking that there'd be 6 rate cuts. And the reason that we've made it all the way to the June meeting without one is the Fed seems to be ready to cut rates, and they're ready, and then the data comes in and it's too strong, and it's too strong, and it's too strong, and they could never quite get to the point where they could cut rates. And now the takeaway here is, look, we're still 5 or 6 months away from the next rate cut, and there's a lot that can happen in that 5 or 6 months that could, push them one way or the other.
And do you think that today's weak inflation reading, lower than expected, influenced the dots, influenced Powell's comments? Nick Timmeros, your Forward Guidance guest, as well as a very accomplished journalist at the Wall Street Journal, asked him that question, and Powell reminded him and the other journalists that the Fed and FOMC participants did have the ability to change their dot plot. And of course, he can change his comments because he has control over his comments. But he remained silent, did not answer the question of whether there were actual changes. Do you have a guess on that? And that's all we can do is guess.
Right. He did say that some members, he said most members don't change their dots, which of course implies that some might actually change their dot. Now, why is that important? Why does it matter if they change their dot? Because if they're reacting to today's data, to today's inflation report, most likely they're marking down their forecast because of the data of the report today, meaning that 24 hours ago, we might have had even higher dots than we saw that was actually released. And those dots, to use a market term, are weak hands. Yeah, they mark them down until we get another decent number next month, if we get another, and then they go back the other way. So that's why it seems to matter. And that's why if the argument is most didn't and some did change their forecast, well, no one's going to change their forecast based on today's inflation report and increase their dots. Now I thought we would cut rates twice, but after I saw today's inflation report, I only want to cut rates once. No, you went the other way. You were at one rate cut, you went down to two. So if some did, that does suggest that there's a little bit more hawkishness, and the recent switcher doves are a little bit more weaker handed on it. And I would suspect that some of them might have actually done that. Probably more, if I had to guess, towards the governor side than the president side. Remember, the difference between a governor and a president is a governor works in Washington, and believe it or not, they are assigned exactly one assistant. If you're a governor, you have to do all the work on your own. Now you can ask the Fed, can I have some staffers help me with some stuff? But they're not really your employees. If you're a bank president like the Cleveland Fed or the Chicago Fed or Kansas City Fed, you have a department of dozens and dozens of economists and statisticians and senior economists, and you have a PR department, and your dots are really borne out through an entire committee process over a period of many weeks. So if anybody's going to change their dots, it's probably going to be a governor.
That's very interesting. I hadn't thought of that. And are there any consequences of that might have impact future Fed policy, because governors and presidents have different roles?
Yeah, the biggest thing about a governor is the last governor to dissent at a meeting was Mark Olson in 2005. So it's been 19 years since you've seen a dissent. All the dissents that we've seen have come from bank presidents. In fact, the last bank president to dissent, I think, was Esther George or Jim Bullard, both of them two dissents in 2022. And there hasn't been one in 2 years. So that's where, the governors tend to come in. But the other thing to keep in mind too, if you look at the dot chart for 2025, you see a wide range of dots. You see one dot up at 5 3/8, meaning there's one Fed member that thinks there will be no rate cut this year and no rate cut next year. There's another Fed dot at 275. That means that there's another Fed member that thinks between now and the end of next year, over the next 18 months, there's going to be 10 rate cuts. So you've got from 0 to 10 and everywhere in between. Now, Mohamed El-Erian described today's conference as being confused and confusing. And I agree with him. It was confused and confusing. And I would argue to you the reason it is what Jay Powell does at the lectern is he doesn't say, here's my view of the world. He's saying, I'm going to summarize what the committee thinks. But the problem is the committee is not in agreement. They're all over the lot. Like I said, there's one member that doesn't want to cut rates for 18 months. There's another member that wants to cut rates 10 times in the next 18 months and everywhere in between. So when you try to summarize a group of people that are that disparate on what they think they should be doing over the next 18 months, you're going to come off as confused and confusing because the committee itself is not that way. And that's why you heard him say a bunch of seemingly contradictory statements about, that the labor market is strong, but the payroll market might be overstated. Well, which one is it, Jay? Is it strong or isn't it strong? Yeah, we're in a good place with inflation, but we just changed our core inflation target from 2.6 to 2.8. So are we in a good place, Jay? Because you just raised your target. And so part of that reason that you saw some of these confusing reports is because he's got a committee that's not in agreement.
They raised their targets for 2024, 2025 rates, as well as the longer run rate from 2.6 to 2.8%. Powell somewhat dismissed that question and said that the longer run rate is a very useful and interesting theoretical concept. But if you want to determine where in the near term rates are going to be, it's not what you're going to want to look at. So Powell did. I agree with you that this was definitely a head scratcher. Powell gave something for everybody. He said the labor market was strong. He also said it's going into greater balance. He said there was softening. And he also acknowledged a theory that he made minor lip service to it last meeting, but this time he really said, he acknowledged the theory that the non-farm payrolls that come from the establishment surveys, that in other words, we added 325,000 jobs last month. Those are on paper extremely strong. And he said that there could be a theory that they're not as strong as they might indicate, or in other words, that they may be having some overstatements. Does this strike you as significant that he said out loud that theory that actually the labor market might not be as strong as the non-farm payroll gains are indicating?
Yes, I do think it is, and I'm going to push back on two things that Powell said that you highlighted there. Let me start with the payroll report. The assumption is in the quarterly estimate, the QEW, the quarterly estimate of the state numbers, that those numbers are looking to be a little bit weaker than people thought. Now, we've seen this before, that those numbers that come in from this quarterly state estimates are either stronger or weaker than the actual payroll reports. But that's not what's used for the benchmark revisions. And every year they do a deeper dive into the data, and then they kind of benchmark it. Remember that the payroll report is constructed from a survey of 60,000 businesses, which employ collectively about 1/3 of the American labor force. And so they look a little deeper into the numbers when they have time, and that's when you get these benchmark revisions. And so just because that QEW report is weaker than expected, there's this broad-based assumption, then that means that the payroll report has to be lowered. And then you've got the contradiction with the household survey. Well, the household survey is a survey of 120,000 households. They literally ask somebody like you or me, are you employed? If you're not employed, have you been looking for a job? They ask you all those kind of questions, as opposed to asking employers, which is referred to as the establishment survey, those questions. Now, the big problem there is that there's an assumption that somehow the household survey is correct in showing that it shows more weakness than the establishment survey, and the establishment survey will be revised down to the household survey. That's not always the case, that it goes that direction. Add to that what you might be seeing in the household survey is we have 7 million undocumented migrants that have moved into the country since 2021. And they might start getting picked up in some of these surveys. And the unemployment rate among undocumented migrants is very high, because you need a permit to get a job if you don't have a social security number. Because the first thing you do when you get a job, I get a job, is you go in your first day and you fill out forms, and you need a social security number. Well, if you're from another country, came across the Rio Grande, you don't have a social security number. You need a special work permit, and those are very difficult to get. And if those people are showing up in the household survey, they're going to be showing up as unemployed, most likely, or more likely to be unemployed, pushing up that unemployment rate and making the household survey look a little bit weaker. Bottom line is, this whole migrant movement we've seen in the last couple of years is really going to mess these numbers up a lot, because we also don't survey for it. We don't ask if you're, an undocumented migrant, because up until 3 years ago, it was never really a big issue that we needed to really, get our arms around. Now we do, and we don't have good data for it. If I could go on to the other thing real quick, I don't want to let this one go.
Mm-hmm.
Paul said that the long-term dot is an interesting theoretical exercise. I'm going to push back on that. I think it's more important than that. The long-term dot never gets talked about because it was stuck at 2.5% for 5 years. Now, what is the long-term dot? It's another word for a phrase for that is it's the neutral funds rate. How do they come up with 2.5%? That's referred to as R star in Fed lingo. The long-run inflation rate is the target is to get the inflation rate back to 2%. And then I'll put a bit of a premium on top of that, 0.5%. So that's how you get 2.5% or R star. But if the long-run inflation rate is actually more towards 3 or 3 to 4, which is what the CPI rate has been for the last year, it's been between 3 and 3.5 for the last 12 months. And so if that's really what the long-run inflation rate is more like 3, and that 0.5% on top of that, because if it's a little bit more uncertain, you want to stick 1% on it, we might be looking at a long run neutral rate closer to 4. The market, if you look at the long-term Fed fund futures, like the 2026, 2027 Fed fund futures, imply about a 3.5, 3.6% neutral rate. Now, why does that matter? Why is it a theoretical exercise? Who cares? If the funds rate's at 5.5, 5.25 to 5.5, and the Fed thinks that the funds rate, the neutral rate for the funds rate is 275, they've got to cut rates 9 times to get back to neutral. This is why they keep talking about cutting rates. We got to get going. We got 1 rate on the dots for this year. We got 4 for next year. If we do that, most likely they won't. We're only halfway back to neutral. And we're not getting back to neutral till 2026. But if neutral actually turns out to be closer to 4 and not 275, now all we got to do is cut rates 4 or 5 times and we're back to neutral. All of a sudden, the urgency to cut rates goes away because you're not as restrictive as you think you are, because you don't have to go that much further down to get to neutral. So I do think it matters. I think it matters that they're starting to revalue where is that neutral funds rate, and it's starting to come up. Now, they're not going to jump from 2.5 to 3.5 or 4 in one meeting, but I suspect that over the next several quarters, they're going to continue. That number is going to go up and up and up. And all of a sudden, to get to neutral, is going to be less and less rate cuts. Why? Because I believe the inflation rate is not going to be coming down towards 2%. I think we're in a 3 to 4% inflation world. I'm talking about year-over-year CPI. We have been for 12 months. If you look at the base effect, which is what are the monthly CPI numbers you're going to drop from June and July of 2023, those are 0.2s and 0.1s. And what are you going to add in June and July of this year? It's probably going to be higher than that, and that the year-over-year number is going to go up. That was the first question that Jay Powell addressed. He said straight up, look, in my words, there's a base effect, and we're going to see the year-over-year inflation rate, kind of trend higher. That was one of the arguments he gave for why they upped their core PCE forecast from 2.6 to 2.8. Look at the core PCE numbers we're going to be dropping. We're going to be dropping numbers less than 1/10 in a couple of months. And if we even get 2/10 numbers, people say, well, this is great. It's 2/10. It's still going to cause the year-over-year number to go up. And it's going to cause the Fed to be nowhere near their 2% target.
Forward Guidance is brought to you by Van Eck. The Van Eck Morningstar-wide MOAT ETF, ticker MOAT, has outperformed the S&P 500 for over a decade. How? MOAT strives to achieve a simple but challenging task: buy quality stocks when they're undervalued and sell them when they're overvalued. Visit vaneck.com/MOATFG to learn more. That's vaneck.com/MOATFG. Now the disclosures. All investing is subject to risk, including the possible loss of money you invest. Visit vaneck.com to carefully read a prospectus before investing. The Van Eck Morningstar-wide MOAT ETF is distributed by Van Eck Securities Corporation, a wholly owned subsidiary of Van Eck Associates Corporation. Thanks. Let's get back to the interview. Right, so base effects is because inflation is measured on a year-over-year basis. If in July the CPI index, or let's say in November the CPI index was very high, inflation in November 2024 is going to actually be lower because it's comparing relative to 2023 when it was that high. And can you connect the longer run interest rates from which is now 2.8%? Relative to the real neutral rate? In other words, if the 2.5% rate, longer run neutral rate, I think of that as the Fed's inflation target of 2% plus a 50 basis points of a real neutral rate. Where do you think that increase is coming from 2.5 to 2.6 and then now from 2.6 to 2.8? Is it coming from sustainably higher inflation, or is it coming from an increase in the neutral real rate?
I think it's coming from sustainably higher inflation, and that, the Fed is looking at the earliest 2025 or 2026 if they're going to get back to 2% at all. And my bias, let me bring up front, I've been arguing this now for 4 years. The 2% inflation world ended in 2020 with the pandemic shutdown and restart. We are in a new inflation world. We are not going back to 2% unless we have a recession or a serious slowdown in the economy. And then it will only last as long as we have a recession or a serious slowdown. In a minute we recover, the inflation rate will bounce back up. So I think we're in a higher inflation world. And I think that there's more and more of an acceptance that we're in a higher inflation world. One of the things that Jay Powell said was, he said 2.6 or 2.7 core PCE is a good place.
Yes.
That's exactly what you said. 2. Now, that's for stock people listening to me, that's like somebody saying, what's your stock forecast for the S&P? Oh, I don't know, 4,500, 5,500. Wait a minute, that's kind of a big range there between 4. That's what 2 to 2.7 on inflation is. That is a monstrous difference between those two numbers. At the beginning of the press conference, he said their goal is to get the inflation rate to 2.
Yeah.
He means core PCE, by the way, is what he means. Then he said 2.6 to 2.7, 2.6 to 2.7 core PCE is a good place. That's not 2.0, Jay Powell. That's much higher than that. And what I'm trying to say is, for those that are not steeped in these inflation numbers, what's the difference between 2 and 2.6? That's like somebody saying my S&P forecast for the end of the year is 4,500 to 5,500. Well, that's not like a useless number because it's so wide and there's so much variability in there. That's a big difference is what I'm trying to say between 2.7 and 2. And so if he's going to say 2.7, 2.6 is a good place, it almost sounds like he's willing to give a little bit on that 2% inflation target, even though he stated that that's their long run goal. And that may be why those dot charts are starting to come up as well. I think the other reason he wants to downplay it is he doesn't want to be asked the question you just asked. If the dot chart started moving above 3 and the 3.25, people are going to start saying, is that because you don't think you're going to get to 2% on inflation? And that you're never going to hit your goal that you've been telling us for 3 years that you're going to hit? And that another blow to Fed credibility when it comes to, inflation. He doesn't want to have that issue. So he wants to basically say, it's a theoretical exercise. Don't ask me any questions on it. It's not important. Let's move on to the next thing.
Yes. And I think he didn't mean, our actual, that 2% target, who cares? I'm happy with 2.6, 2.7% inflation. I am almost positive he did not mean that. But when you just take that quote, it kind of sounds like he's implying that. And then, of course, CNBC put on the headline, Powell, 2.6 or 2.7 inflation sounds good to me. Do you think he regrets that right now, saying that soundbite?
I think he might a little bit. Because ultimately, the way he'll spin that is, of course, we're looking at our, trying to get it to 2%. Yeah, but Jay, you just said now, if 2.6, 2.7 is a good place, you're saying to me that it's the second half of 25 into 26 is now when you think you're going to get. Now we're pushing 5 years past the time you said that, inflation was transitory before you eventually got back to your target. He might be, regretting that a little bit. I think the bond market didn't take it well. Yields went up about, we were at about 426, 427 on the 10-year note. And right after he said that, we traded about 432. So, for 10, 15 minutes, that's a decent sized move. And it was a kind of a reaction. The dollar went up a lot on that news as well, because if that means that the Fed is going to tolerate higher inflation, we're going to have higher interest rates relative to the rest of the world. And that put a bid in the dollar as well. So he might have regretted that a little bit in respect, but no one really challenged him on it after he said it.
Right. As you say, the 2-year now at 4.76, shooting down after the a good inflation report, lower than expected inflation report, and now rising back about halfway of the way. And so the overnight rate is at 5.3%, in that 5.25 to 5.50 target range for the Fed. So just to frame this for our audience, Jim, we are in a world right now where the bond market is very inverted and the short end of the yield curve is very inverted. In other words, the market is pricing that interest rates will go down, not up. And that assumption makes sense when at the beginning of the year, the Fed forecasted 3 interest rate cuts, and the market was pricing 6, I should say, up by the end of the year. But I was very interested to see the analysis of both of Jeffrey Gundlach as well of Steve Leisman, who asked the question that the Federal Reserve dovish tilt is gone. In other words, its bias that it's not going to hike rates is gone. Do you agree with that?
Yeah, I do think that the Fed, the dovish, if you mean is the dovish tilt here and they don't want to hike rates. Yeah, I do agree with that. that they're really not looking at potentially hiking rates anymore. They're only looking for a reason to cut. And I might add, that's been pretty much the case for a year now. If there was one exhale out of today's inflation report is, oh, good, at least we don't have to talk about the potential for a rate hike going forward from here, because that kind of did creep up into the lexicon a little bit after the payroll report last Friday, especially when wages came in a little bit hotter than expected. Could there be potentially another rate hike several months from now if this data doesn't start to moderate? Well, 3 days later, the inflation report did moderate.
Got it. Now, let's return to the labor market. So correct me if I'm wrong, the unemployment rate comes from the household survey, and the non-farm payroll data comes from the establishment survey. Okay. The unemployment rate has ticked up to 4%, whereas non-farm payroll gains are still strong. You're saying that that could be explained by undocumented immigration being counted in the household survey. Which is it, Jim? I mean, which, if you had, the answer could be both, but I'm taking that off the table. You can't say both. Which is telling a more accurate story of the labor market? The household survey, which shows a softening, maybe even weakening labor market, not recessionary levels, but weakening, definitely weakening, or the establishment survey, which shows no problem, 300,000 jobs, 200,000 jobs, the economy's booming. Which is it? You have to choose one. You can't say both.
Oh, I'll say the establishment survey easily. Okay. And the reason that I think that the establishment survey, that's the survey of 60,000 jobs, companies. By the way, over half of the companies, of those 30 of those 60,000, they have their payroll processor, whether it's ADP or Gusto or one of the other ones. They just basically are instructed to automatically send a file to the BLS of all the payroll information that they have. By the way, for everybody who's worried about privacy, they only send metadata. They do not send your name and your social security, but they send everything else. I employ so many people, and I employ so many of them that are male and female and their ages and how much they make, but I don't tell them your specific name or your social security number. So that's 30,000 of them right there. It's literally a data dump from their payroll processor. The other 30,000 are people that go to the Fed's website, or the BLS's website to fill out the form, or they do it over the telephone or something like that. The household survey is like a political survey or anything else. Are you employed? Yes or no. If you're not employed, did you look for a job in the last 30 days? You define looking for a job in the last 30 days. I stared at my phone for 2 minutes. I looked at Indeed for 2 minutes on my phone, and that qualifies that I look for a job, or I actually had an interview. I mean, and so if you are picking up as your household some undocumented households in that survey, and you could, and the idea again is they don't have a social security number, so there's more unemployment in those cohorts, because the first thing they're going to ask you is, are you a citizen? Do you have a social security number so I can withhold taxes? And if you don't have a social security number, a lot of households a lot of establishments cannot hire you. You're going to say, no, you don't have a job. And that might be skewing the unemployment rate higher. Now, again, I'll emphasize, we've never had to make that distinction. Are you an undocumented migrant household, or are you a native born household, until 3 years ago? So we really don't know how much of it is being captured in the data, but there's so many of them, 7 to 10 million is what the consensus is, that it's reasonable when you're serving 120,000 a month that you're going to start picking up some of those households, and that might be skewing the household data higher. Now, you could argue, well, maybe that is accurate because we've got these people that aren't working in our country. So maybe that does mean that. But as far as the establishments, these are people that are paying paychecks. I've always thought that that's been better data. Now, that's got problems too, because it's a survey and it gets revised as well and everything else. But if you ask me between the two, I'm always going to pick the establishment survey.
So it does make sense to me that undocumented immigrants could be picked up in the household survey. But Jim, just to push back a little bit, if let's say you moved to France and you got a job crushing grapes with your feet at the winery, and you overstayed your visa, and you technically were an undocumented immigrant in France, and the Bureau of Bureau de Labor de France calls you, you don't think you're gonna say and hang up the phone because you don't want to attract some heat on you?
Yeah, I mean, well, that's a disconnect rate that you might see all over the place that you don't want, and that is a problem that all surveys have. I mean, look at the connect rate on political surveys. When you ever see a Gallup survey and it says 2,000 Americans responded to a Gallup poll and said that this many are gonna vote for Trump and this many are gonna vote for Biden, you realize that they had to probably call 150,000 people to get 2,000 people to answer those numbers. I mean, the connect rate is like less than 5%, around 3%.
And the people who respond could be nuts.
Right. Well, that's why, they go through lots of effort to try and clean that up. And that could be the case with the household survey. I'll start answering some questions, you might be interested in, and sure, I'm going to ask questions. And then you ask me about working, and I might say, no, I don't have a job, but I do have a job, working in farm fields, doing farmer work, labor work, and I'm being paid under the table. And I'm a little bit afraid to answer that question. I don't want to say, yes, I have a job, because maybe somebody's going to start coming and knocking on my door and going, why aren't you paying taxes? What's this job that you're talking about? So you say, no, I don't have a job. So yes, there is that problem with the survey. That's why we do deeper dives and we have benchmark revisions. And by the way, we can't really solve that in any simple way, because a lot of people say, why don't we do away with the household survey, the establishment survey, and why don't we just go to the IRS and ask them how many people are getting withholdings every month, the entire country down to the person. We don't need to know your name or your social security number. And we could do that as our job establishment survey. Sure, we could do that, but that still doesn't capture people that are unemployed. And that still doesn't give you the population to employment ratio. It doesn't give you the unemployment rate. You still have to do surveys of households to get this data. And if the households are starting to change because of migration, then you're going to start getting some screwy numbers. So yeah, I mean, neither one of them is perfect. But going back to the question you asked me before, I had to pick one or the other. I'm going to pick the one that's saying who's paying paychecks, as opposed to people giving their opinion about whether or not they have a job.
That makes sense to me. And Jim, what do you make of the critique that the establishment survey employs something called the birth to death ratio, which assumes how many new businesses are created versus how many businesses go out, or that birth and death. So not referring to human life, referring to businesses, birth to death ratio. And
Right.
our mutual friend Daniel DiMartino Bruce has brought that up to say that there could be a disconnect, and that the BLS could be drastically overstating the amount of jobs because it's relying on the assumption that a lot of new companies have been created that actually haven't been. What are your broad thoughts of that argument?
So two things. A third of the American workforce works for a company of less than 100 employees. I am a company of less than 100 employees. I don't know if Blockworks has gotten over 100, but you might be an employee of less than 100 companies. Daniel DiMartino Booth, our friend, is a company of less than 100 employees as well too. So a third of the workforce is like that. And a lot of people that work at those small companies, they're newer companies. So the first thing you mentioned is the birth death model absolutely has to be part of the survey, because so many of us get our jobs at small companies, sometimes newer companies. These newer, smaller companies that employ people might not be part of the establishment survey. They could be. If you use a payroll processor that asks you if you want to be part of the survey, you could be. But otherwise, the need for the birth death model is critical, because that's the biggest part of where we get new jobs, is new companies being formed versus old companies going out of business. The death model is part of it. And yes, it is a very, very difficult process to put that together. The reason I say that is because so many people push back on it, like, this is a fraud, the birth death model. No, it's hard to do. I get it. It's very hard to do, but it's not something that you cannot do without. Let me turn it to the other side. There are less people today employed at companies of over 10,000 employees than there were in 1980. Now, why is that? Let me use one company in particular. General Motors employs about
Hmm.
35 or 40% the number of people that they employed 44 years ago. Why? Robotics and technology. You need 1/8 the number of people to build a car today than you needed to build a car 50 years ago. The rest of it is done by robotics and technology. So big companies are always pushing the envelope of productivity so that they don't need to hire thousands and thousands of more people, that they're looking for ways that they could be productive and not have to do it, and that pushes everybody down to lower, smaller companies, especially companies less than 100. I think half the workforce is less than 500 employees in the United States. And so therefore, new business formation is critical in trying to determine what is going on in the labor market.
Very interesting. So even though over the past 40, 30 years, there has been a corporate consolidation and that, a greater, the bigger companies have gotten bigger, their profits have gotten even bigger, but you're saying impact on the labor market, actually, there are now fewer people who work at these mega corporations just because they don't employ as many people. That is a very interesting thing.
They don't need to. They can get the same amount of output, productivity output, with less employees because of computers if they're in a service sector job, or robotics if they're in some kind of a physical labor or manufacturing job.
And Jim, while we're talking about dissecting the data, let's move on from the jobs market to the inflation report. What is your outlook for inflation? You already talked about base effects, how it could have a lower base going forward. So year over year, things will be higher, which is on the margin going to mean higher year over year numbers. But either looking at the subcomponents, for example, I know car insurance has been sky high, as high as 21, 22% year over year. It has finally dipped down. Either looking at the subcomponents or just your overall macroeconomic view, what is your outlook on inflation? In other words, what is motivating your higher for longer, higher inflation thesis other than base effects?
Well, base effects is a big one, so I don't want to leave that off the table. But there's two other things. If you were to look at the report, yes, you're right. Auto insurance went from a 22% annualized rate to negative in 1 month. And that did help really push the numbers down. Not because auto insurance is a big part of it, it's only like 0.17% of the report, but it was such a massive move. But and then you've got restaurants and airline tickets and used cars and a lot of these other little quirky things that are very, very volatile. Sporting tickets is another one that are very, very volatile, that jump around, that could actually show up when the market is celebrating the difference between 0.0% and 0.1% on inflation. Yeah, all these little things can maybe push it 1/10 1 month, and that elicits a major response out of markets. But now that I've said that, there's three big things that I'm looking at in the inflation report, and I think that they're going to be sticky. The first one that I'm looking at in the inflation report is energy. Energy is a big part of it. Gasoline is 3.5% of the CPI report. Gasoline could move 15% or so a month either way. It alone can add or subtract 2/10, sometimes even 3/10 out of the inflation report. Right now, I think gasoline is stabilizing at around the high 70s, low 80s. And so it's not going to be a negative or a positive. Gasoline was a big drag on the May report because it fell in May, but we're only halfway through the month, but it seems to be stabilizing right now. The other one is owner's equivalent rent. That's a very contentious issue. A lot of people on Wall Street have been, for 2 years, have been arguing owner's equivalent rent. This is an algorithm that the BLS uses to say, what if you rented your house? What would you get for it? And then would you get more or less? And that's how they impute housing inflation. The reason they do that is because a house is kind of a funky asset. It is both a financial asset and it's a real asset. Maybe my house goes up in value because I live in Miami and everybody wants to move to Miami and home prices soar. Well, that's not inflation. That's the real value of my home going up. Or maybe the value of my home is going up because everything is getting more expensive, including homes, and that's inflation. So they use this OER method to try and separate out the real asset versus, the inflation part of it. Now that number has been sticky high. It was another 0.4 this month, And people were really, hoping they would start to see 3/10 and 2/10. I've been saying that for over a year, and it hasn't been coming down. I've been arguing the reason it hasn't been coming down is if you look at the cumulative gain of owner's equivalent rent since 2020, it's up about 28%. But if you look at things like the Zillow Apartment Index or Case-Shiller or apartments.com, cumulatively, they're up 40 or 50% over the same period. Now, yes, people point out, yeah, but the new tenant index of the, the BLS and stuff like that, that's falling. Yeah, but look at the major gains that they had going into this period. And Powell even mentioned that in the press conference, that there still has to be some kind of a catch up on this. The reason that these housing numbers are so strong is because they're still understating the cumulative inflation that we've seen over the last 4 years. That doesn't mean they have to go up. They're just going to come down slower to eventually catch up. And then the third one is wages.
Sorry, Jim, I just want
Yeah.
to zoom in on shelter, which at 34% of the CPI, a huge impact. Most of that is owner equivalent rent, which, as you said, trying to isolate it's the consumer price index, and you consume renting apartment. And if you own a house, you're still a consumer of that unit, and they want to separate that from, oh, there's a giant real estate bubble and my house has tripled in value, because they don't consider that part of inflation, which it's not part of consumer inflation, although it is related. But if Zillow has gone up 50% and OER has only gone up 30%, isn't part of that increase from Zillow a speculative asset and not a consumer price good?
Yes, some of that is. That is that, so that's why I would say that OER does not have 20 points of catch up to go from up 30 to up 50. But the perception is that not all of that difference between OER and Zillow is just that speculative part of it, that everybody moved to Miami. And the reason I picked that is probably the hottest apartment market in the country right now, or at least was until very recently. And so that's why I think you're going to continue to see stickiness in in housing inflation, and it's not going to come down. And as you pointed out, it's 33%. And then there's another one called rents of primary residence. It's this kind of the same thing just for renters, and that's about 9% of the CPI, and that encompasses over 40% in CPI. So that's a big one. And then the other one I was going to say was Supercore. That's the Fed's Powell's measure of Supercore, which is core less housing services, which is a way to measure. Basically, what he's measuring is wages, is what he's measuring. And that's been running at around 4.5%. And that's very similar to what we've been seeing in the payroll report with like unit labor costs and stuff like that running at 4%. Remember, if everybody in the country is getting around a 4% wage hike, they can pay 3 to 3.5% inflation and still wind up getting ahead because their paycheck is still outpacing inflation. 2% inflation with a 4% with a wage hike, it won't last very long. That's too much of a real gain that you'll start seeing changes in patterns and people start bidding things higher as well. And that's why you can't really see much of a gap between wages and the inflation rate. So if wages are going to stay in that 4-handle range, it's great. I mean, nobody doesn't want to raise, but the consequence of that's going to be everybody's got money in their pocket to buy things, and then they're going to push up the price of those things, probably, in that 3% range. So add it up. I talked about energy is going to probably stay sticky. It's not going to go down. Oh, and I might throw in OPEC just cut, or said they're going to hold their production cuts through 2025. They want to see prices go up. Then you start with OER staying sticky because it's still got a little bit of catch up to do, not all the way because of that speculative element that's there. And then if you've got wages still running at around 4%, add it all up. I think that the inflation rate is in a 3 to 4% world. And as I mentioned earlier, for 12 months, that's exactly where we've been. The low was June of 23 at 3.0% year over year CPI. We're at 3.3 right now. We have not been below that June of 20. So it's been a year since the bottom we've seen in the inflation rate. And we've been in that 3 to 3.5% range. And with that base effect, we're going to stay in that range. And when you start thinking about energy and OER and wages, that we're going to stay there. Now, last thing, maybe something comes along and changes that equation. There's, unrest in the Middle East and it spikes oil prices and makes it worse, or that the economy winds up, going into recession and weakening, and then that wage inflation or that OER number then really starts to come down just because demand falls off the page. That could change the equation. But unless or until something like that happens, you're probably still going to be in a 3 to 4% inflation world.
Right. That's really interesting. Jim, I did an interview with this data engineer who constructed a tool to visualize the CPI and the PCE. It is really cool. I will send it to you later. But he had a fascinating statistic that going back to—
Put it in the show notes too, now that you mentioned it.
Yes, it hasn't come out yet, but so our interview will air before that interview airs. But one lesson is just how much the labor market is of the growth has been in the medical field, and that appears to be an era of secular growth that is not immune, but much less sensitive to interest rate hikes. But on the CPI front,
by the way, real quick, what the medical field also has that you remember I said that big companies try to automate away jobs. It's really hard to automate away nurses and orderlies and stuff. And so about a third of all job creation in the United States is in the healthcare field, because the healthcare field is still a field that needs human beings to do it. And, robots and kiosks are just, you're not going to go to the doctor and basically push a bunch of buttons on a kiosk to basically go through your annual physical. You might do it to order something at McDonald's, which is what they're trying to do, but you're still going to want to see a nurse, and you want to see the doctor, and they're going to need an orderly to clean up the room after you're done with your exam, and they're going to need technicians to draw your blood. You're not going to allow a robot to draw your blood. So that's why the healthcare field is still one of the few fields left that is still seeing huge employment gains, because it's so hard to automate a lot of that stuff away.
Right. The scene of the Matt Damon movie Elysium, where the robot is your doctor, very, very far away from that. And so
nobody wants that. Even though the technology might be there, you don't want a robot as your doctor.
Right. But the guy I interviewed, his point was that going back to after World War II, there has been 0 months where shelter inflation has been above a certain level. I think about 3 or 4%, and inflation has been at or below 2%. So if shelter stays this high, it is close to impossible. Of course, nothing is impossible, but close to impossible. Very unlikely for the inflation to actually go below 2% and be sticky. Of course, we're still talking about CPI. So, Jim, I now just want to connect a few things. There has been a apparent weakness in economic data over the past 6 to 8 weeks. The GDP came in lower than expected. We had today's inflation reading, and we can see that you've got this great chart of the Citi Economic Surprise Index, and it shows that the data relative to expectations has been getting weaker. You've been getting more economic disappointments rather than disappointments to the upside. Why should we not be concerned about this?
So you could broadly break down economic data into 2 categories, what's called hard data and soft data. Hard data is actual measures of the economy. Think retail sales, think the payroll report, where you're actually measuring the number of jobs. Think factory output, that kind of things, where you're just measuring what people are doing. Soft data is surveys asking people's opinion. Think consumer confidence. The ISM purchasing managers is soft data. It's basically asking a certain cohort, purchasing managers, their opinion about the state of the manufacturing business. The regional Fed surveys, they're also, the Empire survey and the Philly Fed survey and stuff. The Richmond manufacturing survey, those are surveys. Those are opinion-based data. When you break down the data between hard and soft data, what you're seeing is the soft data is really falling apart in the last 3 to 6 months. The hard data is not so much. So the actual measures of the output of the economy are kind of hanging in there. The soft data is weakening quite a bit. Now, what's going on? The biggest driver in soft data is political. When as the joke I always say is, I don't need to ask you your opinion about the economy. I just need to ask you one question. Do you prefer MSNBC or Fox News? And if how you answer that question, I know how to fill out the rest of the form for you.
Mhm.
Because that's kind of the way that we all think about this. That when a Republican is in the White House, the Republicans think the economy is good. When a Democrat's in the White House, the Democrats think the economy is good. And we're in a political season. And when we get into a political season, there's a lot of uncertainty. And boy, is there uncertainty in this political season more than most political seasons. Not the least bit, we might have a candidate for president who's leading in the polls that might actually be in prison in a couple of weeks. You know, that's how uncertain things are right now. So when you look at this data, and by the way, you see this politics not only in the consumer confidence data, you see it in the NFIB, which is the National Federation of Independent Businesses. They tend to skew more Republican as well. You see it in the ISM data. You see it in some of the regional Fed data. So what I think you're seeing in the economic data slowing is you're starting to see the soft data really slow down. And that is more of a political statement than it is an economic statement. You're right. We had the first quarter at 1.3% GDP. The Atlanta Fed GDP now, which was updated last week, and it will be updated again on Monday, is at 3.1%. That is a rebound in the economy. Basically the way you'd look at what's happened with the Atlanta Fed was April looks like it was a weak number, a carryover from the first quarter. And May looks like it picked up a little bit more, which is why the Atlanta Fed number rebounded. But if you look at the hard data, the actual measures of the economy, they're doing okay. I don't want to say they're doing great. They're doing okay. There's no signs of recession. There's no signs of a serious slowdown. Ask people their opinion, and boy, you'd think that the Great Depression was coming by the way that people are answering questions about their opinion.
Well, Trump in an interview, I think, did make a reference to 1929. If Biden gets elected, I believe that's the case. So when you say hard data, that is spending, employment, inflation, industrial production, and it is actual facts. It's not asking people, how do you feel about this? How do you feel about that? It is saying how much money was sent, how much money was actually spent. And the PMI's Purchasing Managers Index, ISM, however you want to measure it, those are have maybe even more sensitive to base effects than inflation, because if the economy is running at an extremely hot pace, ridiculously hot, like let's say late 2021 in nominal terms, a 50 indicating no growth or contraction means it will stay ridiculously hot. And if it's at 49, it means it will just go from ridiculously hot to slightly less ridiculously hot. And so that's why you had these very negative readings in 2022 and to some extent 2023, even though the hard data came in strong. So it sounds like you expect that to continue. You expect the hard data to continue to just outperform the weak soft data.
Yeah. So let me put it to you in these terms. If you look, there was an economist at MIT in the 1970s, Rudy Dornbush, and he made a famous line that economic expansions do not die of old age; they're murdered. And Ben Bernanke has repeated that line many, many times over the last decade or two. What does he mean by that? I've been reading even just in the last week, the economy's rolling over. The economy's going to pop. The consumer's going to stop spending. They don't do that. That's not how it works. They will continue on their patterns until something murders the economy. In other words, the economy will continue to expand at around a 2 to 2.5% pace. Some quarters will be faster. Other quarters will be slower. We just had a slower quarter, but then if you look at the second half of 23, it was much stronger. But it will continue to expand. Why? Because in a capitalist society, we're constantly taking money away from bad ideas and giving money to good ideas. So what causes a recession? Something happens. A pandemic shuts down the global economy. A spike in oil to $150, like it did in July of 2008. A housing crash. 9/11. A war where Iraq under Saddam Hussein invades Kuwait. These are all the things that caused recessions in the past. An Arab oil embargo in 1975 caused a bad recession. So something has to happen to murder the economy in order to scare people, and then they change their behavior, and then you have a recession. So those are not predictable. And you cannot tell me from all of the analysis that you do, the payroll report and the inflation report, that a pandemic is going to shut down the economy. or we're going to have political upheaval that is going to impact the economy, or we're going to have a spike in oil prices because of geopolitics, in the Middle East. Those things happen, and that's why you have a recession. So I've been of the opinion that the economy will continue to expand, sometimes faster, sometimes slower. And only when there's a murder do I start thinking about a recession. Now, to be fair, a year ago, or maybe a little more than a year ago,
Mhm,
I
mhm.
was very worried we murdered the economy with Silicon Valley Bank
So was I.
and that was the murder. Turned out not to be the murder. And we survived that and we moved on from that. So sometimes the murder is not as obvious. I was in the camp when all those banks failed too. Man, this is a financial crisis. And we had one in 2008. And maybe this one won't be as bad, but we could see a downturn. We didn't. We didn't see a downturn at all. So that's why I think the economy will continue to expand. Now, that's not all bullish for the following reason. I mean, it's good. It's better than the economy not expanding because the consequence of that is more demand, sticky inflation. So if I said, look, we're not going to have a recession, we're going to continue to grow, we're going to continue to self-adjust, we're not going to murder the economy. Great, great, great. Yeah, but get used to a 3 to 4% inflation world, get used to 4 to 5% interest rates at a minimum. They're not going down much more than where they are right now, unless we do have that murder weapon do show up. And look, at the state of the world is right now, I have over here to the left of me is my Bloomberg, and I keep looking over there jokingly. I got to see if there's another red headline that flashed across my Bloomberg. Go, we just changed everything, and that could happen at any time, or it may not happen at all. So that's really what causes a recession, and that's why it's so difficult to find one. So yeah, we've had a period of slower growth in the first half of this year. But look at the big numbers we put up in Q3 and Q4 for the economy in 2023. This is just the offset to that.
And so economic expansions don't die of old age, they are murdered. It sounds like you don't think that a nominal Fed funds rate of 5.3% with inflation at 3.4%, so a 1.9% real rate, it sounds like you don't think that is a sufficiently fatal and dangerous murder weapon to take down this economy.
So a very good point that you brought up. I should have mentioned that earlier, that a big murder weapon in the past has been overly tight Federal Reserve policy, that the Fed raises rates until they break something. Okay. Have they rose rates to break something? Not if the stock market's at an all-time high. The first thing that'll break is the stock market. So by definition, by the way, there's never in American history has there been a recession in any month that the stock market made an all-time high. Made an all-time high today, the day we're recording, made an all-time high in May, made an all-time high in April, made an all-time high in March. And so there is not going to be if history is any guide, these months are not recessionary months.
Jim, sorry,
What
is
about July?
that referring to the start date of an NBER recession?
Yes, that is
Got it.
referring to the start date of there has been no start date of an NBER recession. It has occurred with an all-time high. You're off the all-time high. Now, if you look at, to be fair about it, February of 2020, I mean, you made the all-time high in January 29th, and they said the recession started in February. Yeah, in 3 weeks, you were down 35% because of the shutdown of the global economy. You crashed the stock market. So if the stock market continues to move along, the signal I take from that is we're not in recession. Now, if the stock market turns around and takes on water and really goes down, okay, then we can entertain the idea that the Fed has raised rates too much and have broken things. But they haven't raised rates in a year. The high for the cycle in the 10-year yield was last October, 5%. We're at 430 right now. So we're not at, if we broke the economy, it was last fall because of higher interest rates. But we do know that we had a 4.9% GDP in that quarter. So, and we wound up seeing the stock market rebound from a 10% correction and make new all-time highs. So I don't think we're seeing that. But again, that is good from that perspective. But the downside to that is sticky inflation. It's going to keep inflation in the game, and that's not going to go away.
Jim, I know we've only got a handful of minutes left, but I just want to mention you were also the manager of the Wisdom Tree Bianco Total Return Fund, WTBN. So that is an actively managed bond ETF. Why is it that actively managed bond ETFs tend to have a higher likelihood, or I should say that it's more often that actively managed bond funds outperform the bond index than actively managed equity funds outperform the S&P 500, for example? We all know that as an equity manager, actively managed is quite hard and very rare to do to consistently beat the S&P 500. Why is it the case that the bond managers have a slightly better track record? And then what is your strategy to implement your macro view at WTBN?
Okay, so compliance compels me to say this. What I technically do is I manage an index called the Bianco Research Total Return Fixed Income Index, a mouthful. You can find out all about the index at biancoadvisors.com. And so we manage that index, and we have all kind of data out there about why we're overweight these sectors and underweight these sectors. And we do that by a committee that I head. We manage the index. WTBN, the Wisdom Tree Bianco Index, WTBN, tracks our index. If you want an analogy, the S&P Investment Committee manages the S&P 500, and SPY and VOO track the S&P 500. So we're set up kind of the same way as that. But effectively, it's an actively managed index, and it's an ETF that tracks it. Compliance always tells me I got to keep reminding everybody of that. Now, to your question, why is it? You're right. The Wall Street Journal had a story on Monday that so far this year, of 1,700 actively managed funds, these are not only ETFs, but mutual funds and institution and funds and stuff like that, 74% of them are beating their benchmark index. That's actually a little bit above about 50 to 55% is what they normally do. And you're correct. The same number, looking at equities, it's like 5 to 20% of active equity managers will beat their benchmark index over time. There's a number. It's all about the difference between the bond market and the stock market. In the bond market, the index tends to run somewhere in the middle of the pack and now in the lower half of the pack, where the stock market, it tends to run ahead of the pack. Now, why is that? I'll give you one, what I think is strong answer is about, whether or not the difference between all-stars and problem children, as I call it. In the stock market, the Mag 7 stocks, the NVIDIAs, the Metas, the Googles or Alphabet, and, and the like, Amazon, that's the other one I was thinking of. They are heavily the largest weightings in the stock market, and like NVIDIA is roaring ahead. And you've probably seen, depending on when you measure it, the stock market's up 12% this year, and somewhere between a third and a half of the gain of the entire S&P is one stock, NVIDIA. If you're an actively managed investor, I have one question for you. Do you have at least a 6.5% weighting of NVIDIA in your index, if not more? If you did not, I don't care if you're the second coming of Warren Buffett, you've underperformed the index. You can't, if you are not playing in the all-stars, you cannot keep up. Your biggest weightings are your all-stars. And usually your all-stars are your most overvalued companies. If you pass the CFA level 3, all the red flags that they teach you, these companies have. They're over their skis. There's too much speculation. Their valuations are way up there, and they just keep going and going and going. In bonds, your biggest weightings, your mortgages, your high coupon mortgages, your countries like Japan, which is struggling, or your companies that borrow too much money, are often almost your problem children. So when you go in the bond market, you say, what are the biggest weightings in the bond market? High coupon mortgages, Japan, all these over-levered companies that have borrowed too much money. We got to avoid all these things. CFA level 3 says to me, these are bad things and I don't want to have them. And they tend to underperform, and you tend to beat the index. That's why indexation in bonds doesn't do as well. You're better off with an active manager in bonds. In equities, it's because the biggest weightings are your all-stars, and they just keep going and going and going. And if you don't play along as an equity manager, you fall behind. Of course, if you play along in the worm turns, you wind up falling behind as well, too.
That's very interesting. I imagine related to that is also the issue of no bond. Okay, yes, if you buy a distressed bond at 30 cents when the risk-free rate is at 20% and then they go to zero, and the credit spreads narrow a ton, yeah, that's going to have a good return. But it's very, very hard for a single bond, to have an exquisitely amazing return. It is in some sense capped. It is fixed income. And so it's about avoiding the losers rather than picking the winners. And the S&P 500 index is just, it's like, you have 500 gamblers who go to the horse track riding, and every single day they come back, and the ones that won money, you give them more money to bet with the next day. Whereas with the Russell 3000, the small cap index, it is a lot of companies that just weren't able to make it to the big leagues, to be quite frank. And so that's very interesting in the bond market. So yeah, people should check out, where can they find out about the index that you manage? Again, you don't manage the ETF, you manage the index. Thank you for clarifying that.
Yes. So just real quick on that last thing you were talking about. In bond land, it is about preserving capital, and it is about, trying to get a return. And what's different about the bond market now than we had over the last 20 years, as my friend Jim Grant at Grant's Interest Rate Observer likes to say, it's nice to have a yield to observe again.
Mm-hmm.
That if you buy a bond fund, all things being equal, you're going to get around a 5% return, because that's about what the average coupon is in the entire universe of the bond market, is around 5%. When you add in corporates and mortgages and long-term in the inverted yield curve, you're around 5%. So you're starting off right there. Okay, if you buy a bond fund over the next year, you're going to get 5. Dr. Jeremy Siegel did an update of the book Stocks for the Long Run. And in it, he said that the long-term prospect for the stock market is about 8% a year. Now, that's if you buy VOO or SPY, you should get about 8% a year, maybe 16% one year, 0 the next year. But, I'm keeping the example simple, around 8%. Well, the bond market is already at 5 on its yield. It's already more than half of what the expected return of the stock market is over long periods of time. And the bond market, if people point out, the bond market had a terrible first 4 months of this year. Terrible. It was down 3%. Some people say, down 3% is terrible 4 months. You could do that in a day in the stock market. Yeah, because the bond market has way less risk or volatility than the stock market. So a lot of people have been, that same argument about 74% of funds beating, in the Wall Street Journal article, saying that 74% of managers can beat the index. There's been a huge inflow into active fixed income, because I can get most of the stock market, maybe 2/3 of the stock market's potential return, with a fraction of the stock market's risk. That in a disaster, I'm down 2%, or in a disaster like in 22, I could be down 25% in the stock market. Sign me up. I'll take most of the stock market with a lot less risk, and I'll go to an active manager because they can beat the index anyway. So that's why you're seeing this resurgence in active fixed income over the last couple of years. Now, to your other question, BiancoAdvisors.com, you could go see about our index. WTBN is the symbol. You find out more about the ETF that tracks our index. I might as well, since I'm on there, BiancoResearch.com is my research business. If you wanted to find out more about my research business, you follow me at Bianco Research, either on YouTube or on X, Twitter, and Jim Bianco on LinkedIn. I try to stay very active. On our research business, we offer an institutional product that kind of gives you an idea about its price point and stuff like that. But I try to stay active on social media, so kind of give people an idea of what we're talking about on the stuff behind the paywall.
Thank you, Jim. I'll let you go. And we know you got to catch your flight. Pleasure catching up with you. And until next time.
Thank you. Enjoyed it.
Thanks for watching. Remember to check out vaneck.com/MOATFG to learn more about the VanEck Morningstar Wide Moat ETF, ticker MOAT. Lastly, Forward Guidance is available not just on YouTube, but on all podcast apps, and a video version is available on Spotify and Twitter, where I post interviews regularly. Thanks again. Until next time.